Welcome to The Explainer. Today, we're putting on our value investing hats to decode AT&T's complex financial metrics. We want to uncover the truth. Is this a deeply discounted value play with a durable moat, or are we just staring at a stagnant trap? We're taking a rigorous, data-driven look at one of the most hotly debated stocks in the telecom sector. No noise, just the numbers. Let's see exactly what the financials are telling us right now.
So, is AT&T a hidden gem, or is it a classic value trap? Let's dive into this massive question by looking purely at what the data tells us. When you look at legacy companies like AT&T, the market is usually split right down the middle. One side sees a fundamentally sound business trading at an absurd discount, while the other side, well, they see a dinosaur slowly sinking into the tar pits. Our goal today isn't to rely on market opinions. We're letting the raw metrics guide us to the truth.
To start off, take a look at this. AT&T's 20-year total return sits at a really impressive 286.08%, which absolutely highlights its historical pedigree. When you factor in those dividends and price appreciation over 2 decades, this company has undoubtedly generated real wealth for long-term holders. We're talking about an annualized 20-year compound annual growth rate of nearly 7%. So right off the bat, we're looking at a business with a proven track record, not some speculative fly-by-night startup. We're going to tackle this explainer like a classic investment checklist. Here's our agenda. Section 1, the value investor's puzzle. Section 2, the margin of safety. Section 3, the dividend reality check. Section 4, red flags and growth. And finally, Section 5, profitability and financial health. Let's get right into it. Let's start with Section 1, the value investor's puzzle, decoding the contradictions. Because honestly, if you just look at the surface, AT&T throws off some seriously conflicting signals. The visual disparity here is just wild. Look at the stark contrast between a negative trailing 12-month return and a massive 71% 3-year return. I mean, over the last year, you would have actually lost nearly 2.5%. But if you bought 3 years ago, you're up almost 72%. What does this tell us? It tells us AT&T is experiencing severe volatility and constantly shifting market sentiment. It's definitely not moving in a straight, predictable line, which is exactly why we need to dig deeper into its intrinsic valuation. Moving right along to Section 2, the margin of safety, evaluating the discount. As any disciplined value investor knows, protecting your downside is just as critical as capturing the upside. So the crucial point is right here. AT&T currently boasts a massive 31.81% margin of safety against a calculated fair value price of $36.28. With the stock trading around $24.74, the math strongly suggests it's heavily undervalued. A margin of safety over 30%, that is typically a screaming buy signal for strict value investors. It provides a massive cushion if things start to go wrong.
And this brilliantly illustrates that discount. With a PE ratio of just 8.30, it's trading roughly 24% below its own 5-year average. Think about that. You're paying just over 8 times earnings for this business. Now sure, the price-to-sales ratio is slightly elevated compared to its history, up about 3%, and the price-to-free cash flow is trading at a multiple of 10.02. But fundamentally, from an earnings perspective, the market is pricing this telecom giant like it's going out of business tomorrow.
It gets crazier. Even the PEG ratio sits at a staggeringly low 0.10, which just screams value on the surface. If you're not familiar, the PEG ratio factors in growth, and anything under 1.0 is generally considered undervalued. Sitting all the way down at 0.10, which is over 74% below its own 5-year average, well, the market is essentially pricing in 0 future expectations for AT&T. None. Let's move to Section 3, the dividend reality check, yield versus safety. Historically, people bought AT&T for one specific reason, right? That sweet quarterly paycheck. But the data shows us a completely new reality. With a solid 4.49% dividend yield, the payout ratio is currently just 37%, meaning management is aggressively retaining cash. This is a vital capital allocation metric to understand. Out of all the earnings AT&T generates, they are only paying out 37% to shareholders as dividends. That remaining 63%, it's being kept right in-house. And guys, this is a massive shift from their 5-year average payout ratio of over 130%. It shows management is no longer stretching its resources to the breaking point just to pay those dividends. Just think about what that 130% actually meant. They were literally paying out more than they were earning. That is completely unsustainable. Dropping that ratio down to 37% shows a dramatic, highly disciplined pivot in capital allocation. They're finally prioritizing long-term financial stability over simply keeping dividend investors happy at all costs.
However, there's no free lunch, right? The trade-off for that safety is a shrinking dividend, which is contracted at a negative 6.70% compound annual growth rate over the last 5 years. You just can't have it both ways. Yes, the dividend is absolutely safe for now, for sure, but you've suffered a nearly 7% annual decay in that payout to get there. For an income investor who relies on inflation-beating dividend growth, this metric is a really bitter pill to swallow.
Now we arrive at the bearish side of the scales in Section 4, Red Flags in Growth, the stagnation problem. Because listen, as cheap as a stock might be, if the underlying business is shrinking, that beautiful margin of safety can disappear in a flash. This visual disparity is pretty alarming. Revenue and EPS are shrinking, yet net income has managed a 60% 5-year CAGR. This raises some serious questions about fundamental business contraction. Over a 5-year period, top-line revenue has dropped by 1.45% annually, and earnings per share is down over 11% annually, yet net income somehow exploded upward. What does this tell us? It tells us the core business isn't actually growing its sales. Instead, they're likely doing some heavy restructuring, slashing costs, or recognizing one-time gains to boost that net income figure, all while their actual per-share earnings have taken a beating.
Furthermore, long-term free cash flow, or what Warren Buffett would refer to as owner earnings, is decaying at over 10% a year. This heavily weighs against that cheap valuation we talked about earlier. Free cash flow is the absolute lifeblood of any business. It pays the dividends, it pays down the debt, and it funds future organic reinvestment. Watching it decline at an annualized rate of 10.61% over half a decade, well, that's exactly why the market is assigning AT&T that rock-bottom PE ratio.
For our final section, let's take the pulse in Section 5, Profitability and Financial Health, the vital signs. We need to see how well management is actually running the business with the capital they have deployed. Okay, let's break this rapid-fire data down. While return on equity is a very strong 19.41%, the return on invested capital sits much lower at 5.92%, and liquidity is slightly tight with a current ratio under 1. Why the big gap? Well, that return on equity of nearly 19.5% looks excellent on paper, but the ROIC, which actually includes debt in the calculation, is only 5.92%. This discrepancy is completely driven by the leverage on their balance sheet, which is highlighted by a debt-to-equity ratio of 1.26. On top of that, a current ratio of 0.92 means they technically have more liabilities due in the next year than liquid assets to cover them. They're running a very tight ship.
But there is a silver lining here, and it's the momentum. Profitability metrics like ROE and net profit margins are drastically improving compared to their historical averages. That 19.41% ROE, that's a staggering 163% higher than their 5-year average. Likewise, their current net profit margin of 14.36% is roughly 140% better than its historical baseline. So while the top-line revenue growth is definitely stagnant, management is actually squeezing significantly more profit out of every single dollar that does manage to come through the door.
So, looking at the full scale, deep discounts on one side versus fundamental stagnation on the other, we leave you with this final, vital question to consider. You've got a business trading at a massive 31% discount to its fair value, yielding almost 4.5% with a highly secure, disciplined payout ratio. But it is actively combating negative top-line growth, double-digit owner earnings decay, and tight liquidity. The data lays out both the case for deep value and the warning signs of a genuine trap. The ultimate question for your portfolio is this: are these core fundamentals strong enough, and is that 4.5% yield high enough to actually pay you to wait for a turnaround?